So welcome to another version of the AGvisorPOD. This is where we spend some time with partners and experts on the AGvisor Pro platform, and 33Seven has been on for a long time. Derryn Shrosbree is with us of 33Seven to discuss something called the Farm Liquidity Solution, or the tax-free zone. Derryn, good to have you with us. Tell us a little bit about yourself.
Thanks, Rob. Yeah, it's great to be here. I'm the founder and CEO of 33Seven, which is the founder of the tax-free zone and the farm liquidity solution. I too am a farmer. Don't hold it against me, but I am a farmer in Ontario, and we just got our first two frosts, which helped a lot for the sugar content in the carrot. So those are coming out today, and I'm putting in garlic tomorrow, Wednesday, and Thursday. So things are going well in the market garden. And apart from that, I do dabble in finance, and I've looked after about 150 farm transitions in Canada. So if you're looking to transition, you'll do one transition. I'll do one a month. So that's what we try and help folks with. And we specialize in, like Rob said, the farm liquidity solution and the tax-free zone.
I want to bring your attention to a link that's in below in this podcast, which is the link to the Country Guide article that was done and written by Leon Minogue. It was published on October 15th. And if you haven't written the article, it's a really important article. I start out by sharing my personal story. When I sold AgriTrend, I was given some great advice, and I took out some very large life insurance policies, but it wasn't very long before stroking a check for $100,000 a year for premium became somewhat of a burden, because while I wanted to protect my estate, I wanted that cash back inside of my pocket so I could continue to grow AGvisor Pro and the things that I'm currently building. It was through Strategic Coach that Dan Sullivan said, "Do you know the guys at 33Seven, Derryn and Martin?" And I said, "No." And he said, "Well, time to introduce you." And so that's where I really learned about the tax-free zone, where my money goes to work twice. And then we introduce that as the farm liquidity solution to the Power Farm group. And it's a way of taking care of non-farming children while still looking after the farm and not burdening the farm. So my personal story started out the way many business people do. And Derryn, that's not unusual. You've done a lot of work with business people. You've seen my situation before. Maybe start with that business situation, because there's a lot of business people here listening, and then we'll go deeper into the farm liquidity solution.
For sure, yeah. So you're a business owner, you're an entrepreneur. Whether you're a farmer or not we're all very similar people. We want to look after our health, we want to look after our wealth, and we all want to have supper with our family on December 25th. The precursor to that is, as businesses increase in value, as farms increase in acreage and the price of that acreage, more money generally creates more conversations. And some of those conversations can become quite tricky, whether you're a business owner and you have kids that are going to go into the business, or whether you're a farmer and you're going to have on-farm versus non-farm kids. These conversations are going to get more and more complex as the wealth increases. So it's very difficult to have these conversations when you're worth $100 million and you're 78 years old. It's much easier when you're worth $10 million and you're 45, and so on and so forth. So the earlier we can start these conversations about transition, and remember, Rob, transition means growth, not death. You're transitioning away from being the steward to giving all the knowledge to the next steward, because I believe whether you're a farmer or a business owner, you're a steward of time. So if you can use mathematics to help you on that journey, and that's the tax-free zone or the farm liquidity solution, depending on what side of the border you are. So that's what we do. That's what we'd like to help folks with. And like I say, I do one of these a month. You're only going to do one transition in your life. I do one a month. So there we go.
So let's, I'm going to just mention a couple things. If you guys want to get a hold of Derryn, download AGvisor Pro, our application on mobile, iOS, or Android, and you can connect straight to Derryn and Martin on AGvisor Pro. It's a great way to introduce yourself and also have some introductory private conversations. And Derryn is going to be at the Convergence Conference that is being organized for the agricultural sector in Regina on the 4th and 5th and 6th of February 2025. And you're going to be there. And that was, you were there last year at the Convergence Conference, and your session was just packed.
So it was great. So I was just before the keynote, and I think it was either Terry or Warren came in and said, "Can you please stop speaking because everyone has to go back to the main room because the person on the main stage is waiting for the audience." So yeah, we had a lot of folks listening and wanting to chat about transition. Like, a farm is not a pie. You can't cut it up. Fair is not equal. Equal is not fair. These are really pertinent issues. And with the increase in acreage, the price of acreage, and all this kind of stuff, there's just a lot of farmers that haven't really had enough expertise to help them with this very, very large and very current situation. And most advisors have flown over the prairies and they've gone, you know where that is. So, we focus on Manitoba, Saskatchewan, Alberta, and Ontario. Those 4 provinces is where we like to focus. I love the prairies, and obviously I'm from Ontario. So yeah, so Convergence was amazing last year. We met so many new friends and farmers and had a great time. So I'm looking forward to going back to see my friends and to make some new ones.
So, Convergence Conference coming up in 2025, February 4th, 5th, and 6th. Be there in Regina. Now, let's get back to the topic at hand here. I run a peer group for farmers. I've been doing it for 10 years called the Power Farm Group. I introduced you, Derryn, to this group of farmers, and I'm thinking right now of a farm situation. R and J are the mom and dad, and J is the son. And so R and J are in their later 60s, and their son Jay is 27 or so, wants to farm. They have 2 non-farming kids. They need to take care of the non-farming kids. There's got to be a way to provide liquidity upon R and J, mom and dad's death, and yet the premiums could be $200,000-$300,000, which is really too much maybe for the farm to bite off. So in classic farm liquidity solution or tax-free zone, how do I make my dollar work twice? How can I structure it so that the premiums can get paid and the life insurance policy can get in position to protect the non-farming kids and yet get the cash back in the farming operation so it can grow the farm? Explain that and how that works.
Sure. So that's using $1 twice, which is the ultimate farm liquidity.
$1 twice, like that.
Yeah, use $1 twice, which everyone wants to do. So it's very, very simple. You love your children fairly equally. There's 1 on farm, 2 off farm. So one's going to inherit the farm and the 2 aren't. Let's just use easy math. Let's say the farm's worth $10 million, right?
Sure.
So the on-farm child is going to get the farm. Like I said earlier, the farm is not a pie. You can't chop it in half because then you've spent your entire life accruing acreage. If you cut the farm in half, it's no longer viable. So we can't do that. So we need to take the acreage in its entirety and give it to the on-farm child who's probably worked on the farm for 8 years and never taken a salary.
Right. It may be worth $10 million today, but it certainly wasn't. And that on-farm person helped to grow the value of the farm. And that on-farm Jay wants to keep farming on the farm. So it's really what comes down to what is the off-farm children, what are they accepting in terms of, do they want 1 million, 2 million, 3 million? Are they good with that? It's cash. It's not like they get something and have to work in it. So how does this all come together, Derryn?
Yeah, so it's very, very common what we're discussing today. So what we do is this. So using the $1 twice method is, how do you do estate equalization? You have 3 options. You can sell acreage, which we clearly said is not an option. B, we can load the farm with debt, right? Take out a loan and give the off-farm kids the loan, which I'm pretty sure the on-farm child doesn't want.
Right.
Right. So you
don't want to sell the land and assets of the farm. You don't want to load the farm with debt, yet you still have these non-farming children you need to take care of.
Correct. So how do we estate equalize? Don't forget, equal is not fair and fair is not equal. But how do we get it to a portion where everyone can still have Christmas supper together? Because the option, right, you're not going to get a third. It doesn't work. The math won't ever work, not in a million years. Right. But what is the number that gets you to Christmas dinner and everyone's having a great time? What is that number? So that's a conversation. And B, let's look at the math. The math is this. You would take, in your example, let's just say it's $100,000 of premium. Easy math. And you'd send that to Equitable Life Insurance Company. Equitable Life Insurance Company gives the farm a whole life insurance policy. So the deathbed of the policy, easy math, is $1 million. Just say it's $1 million. That's a 10-to-1 ratio, right? And then we fast forward 10 years. So that million grows slowly over time. Let's say it grows to 2 million, which it probably will. So in 10 years' time, you die. There's now 2 million of death benefit. The farm is worth 10. Let's just say the farm hasn't gone up in value. The two non-farm kids would get $1 million of cash each, and the on-farm child would get the $10 million farm. That is basic mathematics. And obviously, the more premium you put in, the more death benefit you have, the more the off-farm kids don't, the more the off-farm kids do get. So I'm just giving you the intricacies of that. So very simply, transaction number one is send $100,000, right? Get your life insurance policy back. But to your point, that's a big sticker. It's $100,000. Like, you need inputs. You got to buy grain. You got to.
Well, a lot of these policies are going to be $200,000-$300,000 premiums.
Even more. Yeah, 500 million. If you're worth $100 million, your premium is going to be about $1 million, right? To make it even reasonably fair. So, how do you take? Let's stay with 100,000. Let's just say, how do you take $100,000 out of your operation a year and still make your farm profitable? Very difficult, right? And we don't want to stress out the farm. We don't want to stress out your balance sheet or your cash flow. So how do we get that $100,000 back? So 100,000 went out. You get the policy in. So now your estate planning is done. Happy days. And everyone needs that because you love your children and you're an adult and you're a decent human being.
Except the farm needs $100,000 back.
The farm needs $100,000 back, right? So what do? Well, second transaction is we go to a bank, any bank, Scotiabank, whomever. You take the policy and you pledge it as collateral for a loan. The bank loans you back the $100,000, so you get the cash back. So now you have the asset, which is your estate planning. So there's your $1,
and that's going to grow.
That's going to grow, absolutely. You got your dollar back, and now you can put it back into your farm.
And that's going to grow.
And that's going to grow. So now you've got two assets growing, and you've used $1.
Yep.
That's the farm liquidity solution, because it gives liquidity upon death, and it gives you liquidity now to be able to facilitate proper intergenerational wealth transfer.
Right. Now, there's lots of details involved, and this is very high level, but it does work. And so for my personal situation, I wanted to make sure that my estate was protected. I was taking care of taxes and stuff, but after a while, I wanted to get that premium back in my pocket so I could grow my business. And that has all transpired. That's worked out well. And we've you put a number of the farmers through the Power Farm group through this, and we'd like to extend this more. So I think this is, Derryn, I think this is one of the most important conversations a farming family can have, and it's a very difficult conversation. And I like the starting point that you made earlier, is if you have two non-farming kids, what are they going to be happy with upon mom and dad's death? $1 million, $2 million? It's cash. So it's not like they're getting the farm. The farm guy still got to work on the farm with all the risks inherent in the farming operation. But at least Jay was allowed to grow the farming operation. Mom and dad die, and each one of the kids walk away with $1 million or $2 million in cash. So you have to sit down and start somewhere, and maybe that's a good place to start. What would you be happy with upon our death?
Yeah, I think the most important part of this entire webinar is the conversation has to start pretty much something like this. Dear son or daughter who aren't on farm, what do you want?
Yeah.
Right? Asking that question is we have the solution. We can do the math for you all day long. That's the easy part. The hard part is sitting down and being like, all right, what do you want? If they come back, you know how many times, Rob, our customers and friends haven't asked their kids. They haven't asked the question. They assume that kids want a third, or whatever the case may be, right?
Yeah, that dog don't hunt, because you can't divide the farm up. The farm is worth 10 million, but it's also got debt, it's got operating risk and everything else. So two non-farming kids probably don't want the farm, either that or they'd already be on the farm.
Yeah. So more often than not, and I've done this, like I said, I do one transition a month. So like we do transitions all day long, and 80% of what we do is talk about the soft skills. The soft stuff is what we're talking about now, right?
Yeah.
So 80% of the time, the parents assume something that the kids actually don't want. So they assume the kids want millions. often, very often, the kids are like, I'm fine. I don't want anything. I didn't work on the farm. It's not mine. And then you know what happens? The dynamic changes because then the parents are even more incentivized to look after them because they're not greedy. But just purely by saying, what do you want? You'll
What do
be
you want?
surprised how many children are like, Dad, Mom, you guys worked for it. It's not my money. I don't care. You'd be surprised. And at that level, then the conversation is easy where it's like, yes, you're just going to get $1 million. Oh my God, thank you so much. That's so generous. That's the one conversation. The other conversation is where there's the non-farm child. Let's say your farm has grown to $100 million. There's a case with brothers that I know well. So there were three brothers, two on farm, one off farm. The off farm brother found out that the farm was worth 100 million, and then he, to your point, came and said, "I need $33 million." And the dad was like, "That's not going to happen. There's no way
That's
we're
not
going to
going to
buy
happen.
can't buy a life insurance policy that big. You can, but that's millions of dollars of premium per year. It's huge, right?" So they had to have that conversation. That didn't go so well, right? But eventually they found a
But
number
at least
that
you started the conversation. The second part of the equation is mom and dad need to pass a medical. I just had a full body MRI last week, and I just got my results back. And the bad news is you're stuck with me for a while, my friend. Anyways, the bottom line is that you also have to pass a medical, and this should not be kicked down the road. Talk about that.
Right. So obviously, every year that you don't do insurance, the premium stays the same because that's the solve, right? But your death benefit comes down. So the older you are, the less death benefit you get. The older you are, the less money you get when you die. So yes, if you can insure your children or grandchildren at 3 years old or 6 years old or 20 years old, they're going to get a lot more bang for the buck, which is a huge amount of death benefit compared to a 60-year-old or a 70-year-old. So most transition is kicked right to the end. So, when they should be doing it at 40s and 50s, they're doing it at 60s and 70s, right? And it just, no one wants to go through this. It's not, this is like getting I don't know. It's almost like getting a root canal. It's not the best experience, but it's necessary, right? And if you put it off and you put it off, eventually they just yank the tooth. Like it's not going to get better. So a couple of
things there for the people listening. Have the conversation with the non-farm. Have the conversation with your children. One, Jay wants to farm. The two non-farming kids don't want to farm. Otherwise, they'd already be on the farm. Chances are they are okay with cash. Got to ask them the question, how much is the cash? And if that's the case, then you need to put a policy in place that's going to take care of the cash. That needs to be qualified with a medical. And then you have to set up a program where the premiums, whether they're $200,000-$300,000, paid out to life insurance policy, you got to structure that so that the money comes back and doesn't encumber the farming operation. So you got to let this dollar roll twice. Now, in the Country Guide article, we had Wayne Poprosky from MNP, Rob Strelchuk commenting, and Dean Klippenstein commenting from MNP about the Farm Liquidity Solution. Can you summarize a little bit around their thoughts? I think a lot of it goes around getting good advice from good tax planning people, getting good advice from, like you say, people that are experienced in this structural side of things.
Yeah, for sure. It takes, farming takes a village. It's the same with finance. It takes a village. So you need a good lawyer, a good accountant, a good structurer, et cetera, et cetera. We're structurers essentially. So we go in, we work closely with your professional services team that's already in place. We had to augment relationships, not to usurp them. We're specialists. We do very, very specific, very highly tailored solutions. Yep. Accountants are generous. It's like a general practitioner. So if you have a boo-boo, then you go to a general practitioner. If you have a brain tumor, you go to a neurosurgeon. We're the neurosurgeon. We're not generalists. We are extremely specialized, right? So we will help accountants to sort of instruct them on how to put this all together and the heavy mathematics that goes behind it. But ultimately, the accountant books all the trades. They put it in the balance sheet, the books and records, profit loss statement, all that kind of stuff. So yeah, you need a whole bunch of folks around you, especially if you're going to do a transition. And if you're going to do a transition well, then you need, your team around you.
And the discipline, like Dean Klippenstein makes a comment in here, and it's really valid. You have to have discipline. If $200,000 goes out from the farm to pay, for the life insurance premium, and the money goes back into the pocket of the farm, and you use it to buy a boat. Bad management. I mean, that's where the caution comes in around leverage financing. That money coming back into the farm has got to be put to work in the farm so the farm grows, and that money inside the policy, the insurance policy, is put there so that policy grows. When mom and dad die, that loan is paid off and the remainder is there in a tax-free manner as well, isn't it?
100% tax-free, yes. Yeah, so the death benefit is not taxable at all. So it truly is a tax-free zone. It's not a deferral, it's tax exempt. So yeah, it's much more powerful than any other asset class when it comes to obviously the tax advantage status of it, because everything except your principal residence is taxed. Your principal residence is tax exempt, but you can only have one of them. Whereas life insurance policies, you can have 10 if you wish. But Klippenstein makes a good point. Just like a house, if you bought a house and then took your line of credit and took as much of the money of the line of credit and then went to Casino Rama and put it on black and it came up red, you're not in good shape. You got to pay it back. Yeah. So tax-free zones are the same. They have the same principle and the same tenets as property. They're almost identical to how property works, except property is taxed, except your principal residence. But this is tax-free. It's tax-exempt. That's a very powerful position.
As I became aware of this, Derryn, I became frustrated because this is not a new program, and the thing is that not enough farmers know about it. And your comment is that this has been an ongoing vehicle in Eastern Canada for a long time, but it's not until recently these farms had increased so much in value. Can you comment quickly on that?
Sure. It's been around for 150 years in Canada, so this is not new. Like, I didn't make it up. It is old as time. It is extremely stable, extremely old, and it's been around forever. But if you look at globally, the Rockefellers have done this. The wealthiest families in the world do it. Jimmy Patterson's done it. So if you know Jimmy, call him. Jimmy Patterson started some of his businesses using the tax-free zone, right? That's common knowledge. So if it's good enough for Patterson, it's good enough for anyone, right? Yeah. There's a lot of folks out there that done it. The Rogers family, you name it, they've all done it. So this is not new, it's not exciting, and it's not risky. It's extraordinarily conservative, right? So as long as to your point, as long as you don't squander the loan proceeds, you're in good shape.
So to wrap up here, Derryn, how can folks get a hold of you?
Through you.
Through AGvisor Pro. They can get a hold of me if you guys want a little bit more information about how this all works. Straight from the horse's mouth. I've been through the process and I've watched farms go through the process. Just reach out to me. Download AGvisor Pro. Reach out to Derryn and Martin on AGvisor Pro. You can find them online, and you can find them at Convergence, again, in Regina. Put that on your calendar for February 4th, 5th, and 6th, 2025. Folks, as we wrap up, Derryn, thank you. Final thoughts, and then I'll just make my final comment.
Oh, no, Bob, thank you so much for the opportunity. I am a farmer. I have 3 children, 1 on farm, 2 off farm. Not only have I done it for hundreds of other people, I do it for myself every single day. So would love to, chat to anyone who needs a bit of help and guidance. And I'm looking forward to seeing you in February, if not before.
Folks, as we wind this up, I don't think there's a more important conversation for you to have in your farming family to protect the legacy of the farm and the integrity of the family. This is really, really important. Elaine Fraze will tell you that these soft conversations have to happen. Time keeps ticking. You got to get this life insurance and policy in position while you're medically qualified. So get moving on this. I encourage you to reach out to Derryn Martin at 33Seven, and we'll see you. And I really, really encourage you to read the Country Guide article that's in the link below. Leanne Minogue did a wonderful job on this. So thank you. Thank you for listening to another AGvisor pod, and share this far and wide with the people that you know and you love. Thanks very much.